And increasingly, they were buying on margin, borrowing money to amplify returns. Margin debt reached 12% of GDP. But beneath this prosperity, warning signs were accumulating. Agricultural prices had been collapsing since 1926. Consumer debt had reached record levels. The yield curve had inverted in 1928, a signal that always precedes recession. Commercial real estate in Florida had crashed in 1926 after a massive bubble. Bank lending had become increasingly speculative. Economists insisted everything was fine. Irving Fisher, the most respected economist in America, declared in September 1929 that stock prices had reached what looks like a permanently high plateau. 1 month later, October 24, 1929, Black Thursday arrived. The market crashed 11% in a single day. By October 29th, Black Tuesday, the market had fallen another 12%. Over the next 3 years, the market continued falling. By July 1932, the Dow Jones had fallen 89% from its peak. $30 billion in market value evaporated. 9,000 banks failed. Unemployment reached 25%. Industrial production fell by half. The warning signs were there, but experts dismissed them. Investors ignored them, and millions lost everything because they believed this time was different. Now jump to 2000. The dot-com boom had convinced an entire generation that old rules no longer applied. The internet was transforming everything. Companies with zero profits were valued at billions based purely on potential. The Nasdaq had risen 400% in just 5 years, from 1,000 in 1995 to over 5,000 by March 2000. Day traders were quitting jobs to trade full-time. Everyone believed this time was different, but warning signs were everywhere. The yield curve inverted in 2000. Corporate debt was at record levels. Margin debt reached 2.7% of GDP, the highest since 1929. Technology stocks were trading at 100 times earnings or more. Many companies had no earnings at all. The Federal Reserve had raised interest rates from 4.75% to 6.5% by May 2000. Wall Street analysts insisted valuations didn't matter in the new economy. Traditional metrics were dismissed as outdated. Then, on March 10, 2000, the Nasdaq peaked at 5,048. By October 2002, it had fallen 78% to just 114. $5 trillion in market value was destroyed. Retirement accounts were cut in half. Hundreds of dot-com companies went bankrupt. The warning signs were there, but experts dismissed them, and millions lost fortunes because they believed this time was different. Now to 2008. The housing boom had convinced Americans that real estate only goes up. From 2000 to 2006, home prices doubled nationally.